Ding dong, school is officially in session, and it is because I got an email from a client the other day talking about something I've been seeing hyped online, and I thought, geez, I better weigh in. I'm referring to the concept of infinite banking, IBC, infinite banking concept. Underneath that concept, what it is a high cash value participating whole life insurance policy. Repeat after me. High cash value participating whole life insurance policy. Well, that's great, Jen. What does that mean? I'm going to give you the breakdown. Whole life insurance. Let's start with the whole life part. That's a permanent life insurance that provides guaranteed death benefit, building cash value over time. Participating means that these policies can pay dividends depending on the insurer's performance. High cash value sounds pretty reasonable, right? It's structured to minimize the insurance component and maximize the early cash accumulation, often through overfunding. For example, paying more than the minimum premium. So this structure is what's used in the infinite banking concept, which is this strategy that's getting hyped. I'm seeing this a lot. We're talking about this kind of policy being pitched as a financial cheat code, but wait. Hold the phone. Hold on. So I'm going to break this down. Why it's getting hyped is because agents make big commissions. I'm sorry. I hate to be cynical, but like seriously, this is the most lucrative product out in the insurance market right now. They're going to promote it hard. They're going to pimp this thing out hard. But just because it's profitable doesn't mean it's good for you. Let's start explaining why with the break-even problem. The break-even problem means that even if you aggressively overfund this policy, it usually takes, I don't know, years to break even because of the high upfront costs. And then, of course, insurance has carrying costs built into it. So that's going to eat away at returns. So you're paying for all the commission stuff up front. It can take anywhere to 7 to 10 years to break even on this thing. So it's in the red for like the first decade. What? That means for a super long time, you've put in more money than you can get out of it. So this is not ideal for shorter term goals or emergencies. This is so not cool for that. You're locking up your cash, paying interest to borrow your own money for something that you're not even making money on yet. It's painful. Let's talk returns first. We all understand you're not going to use it for emergencies. It's a terrible idea to do that. So maybe it's for long-term stuff like big purchase like a second home or college. But here's the deal. These policies are guaranteed not to lose cash value. That sounds pretty cool, right? But they also don't grow like the market. Long-term internal rates of return on these things, maybe if you're lucky, 3 to 4%. And that's only if the dividends continue. And remember, those dividends, they are not guaranteed. They can change year to year. A board can meet up, the insurance company board, and say, yeah, no mas, we're cutting back. Well, there goes your returns. Then there's the issue of what I would refer to as loans, arbitrage, and risk. What about the idea of policy loan arbitrage, the concept that you're borrowing off of your policy at 5%, but you're earning 6%? That's pretty cool, right? So you're basically borrowing for free. I think that's the whole thing that gets sold. Like you're borrowing for free infinitely. Yeah, but that's only if the conditions stay favorable. Remember what I mentioned about dividends not being guaranteed? Then it gets worse. Then it gets even uglier. So let's say you don't pay the loans back. They grow. The interest on it compounds. And then that loan balance eats away at your cash value and your death benefit. Okay, now you got a problem. This whole like guaranteed cash not going down thing, it doesn't work if you're borrowing on the policy. So the worst case scenario, and this will really make you throw up, the policy could lapse, number one, and then on top of that, you'd owe taxes on any gains without seeing the cash. What? The risk factor on this thing is so crazy. If you're planning for something like college, say, okay, in 5 to 10 years or more, there are cheaper, more flexible options. You can think 529 accounts or trust accounts, lower costs, tax advantage, no loan interest to deal with. I've now just sold why it's sucky for most people, but who might it be good for? These products exist not just to scam, but because somebody somewhere could use it, right? It's a very niche strategy. It works best under these 4 conditions: that you love guarantees a lot, that you have maxed out all other tax advantaged accounts. And when I say all, I mean all other tax advantaged accounts. That for some wacky reason, you need a state or creditor protection. And there are other ways to do that too, frankly. And then that you have predictable and excess cash flow for 10 plus years. I know I'm not going to lose my job or I've got a lot of extra money sloshing around. So the moral of the story is this really works if you're already rich. So then if that's the case, what the hell you need to be borrowing off of this thing for? There are ways to do whole life policies that are protective that you don't have to like why would you do this? So, in short, this is not some casual piggy bank for average folks. And I would argue that even if you're wealthier, there are like way better ways to do this. Color me skeptical. Bottom line is, I bang on in the insurance industry all the time. And this is and yet another reason why. When something gets hyped hard online, you got to look under the hood and see why. This is expensive insurance, gussied up, lipstick on a pig, put together as a savings tool, and that should raise all kinds of little flags. So the bottom line is understand what you're getting into, and in fact, don't get into it if you can. These policies can work, but they're not magic. So I hope that helps. If you have any questions, drop me a line, put something in the comments. You want to start a fight with me about it? Let's go. If you've been pitched one of these things, I'd love to hear your take. I'd love to hear your take or ask me about it, and I'll try to talk you out of it 9 times out of 10. Be careful, buyer beware. Hi, I'm Jennifer Kirby from Talisman Wealth Advisors, and I'm a financial advisor who is here to help you do money better. And if you like what I have to say, please be sure to like, to share, to subscribe, and to comment. Thanks.